Hello everyone, and welcome back to another tax talk. In this video, we're diving into the topic of share structure. Let's first look into what a share is. When the company is registered or incorporated, it issues shares. Whoever purchases these shares is the owner of the company. That is, a share represents your ownership in a company. Let's say, a company has 100 shares in total. If you own one share, you own 1% of the company. If you own 50 shares, you own 50% of the company. These shares have different names and types. For simplicity, let's say, company issued type A common shares for $1, and you purchased it for $1. To keep the example simple, you are the only owner of this company. As the owner of the company, you can take the money out of the company in the form of salary or dividend. I've made a separate video on salary versus dividend. Feel free to check it out for more details. Now if you decide to take the money out of the company as dividends, then the process for it is that the company would have to pay dividend to type A common shares, which is held by you, and you get the dividend through your shares. To keep the example simple, in our company you are the only owner. However, there are generally more than one owners and different types of shares. Now let's look into an example with two owners. Let's say you and your spouse decide to start a business. Now you both want ownership in business, but you would like to withdraw more money from business than your spouse. In that case, the business can issue two types of common shares, one for your Class A, and another one for your spouse, Class B. So now, when the business declares dividend, it can declare separate dividends for each Class A and Class B shares as needed. Alternatively, if there was only one class of shares, and you and your spouse had 50/50 ownership in that class, then whenever the dividend is paid in that class, it would have to be split up 50/50 between you and your spouse. So let's say, you and your spouse owns Class A shares with 50/50 split, and when the company declares dividend of say, $100,000 on Class A shares, then you would get $50,000, and your spouse would get $50,000. These classes also have various rights attached to it, like voting rights. So let's say, you have Class A shares which has voting rights, then you have the right to vote for any decisions made in the company like a big investment, or selling something, or hiring, etc. Hence, it is important to understand the rights and split of shares, also called as share structure, as it has a big impact when making company decisions and getting paid. Common shareholders are most common type in a business. They can vote, but they have last right to get paid if the company is dissolved or closed. So let's say, if the company is closing, then first the company has to pay off its loans, debts etc., to outside parties, and then remaining amount will be paid to common shareholders. There is also another type of shares that a company can issue. It's called preferred shares. It's like a priority shareholders. Preferred shares don't have voting rights in the decisions of the company, but they get preference on payment when company is dissolved or closed. Preferred shareholder have fixed rate of dividend, and they get their dividends before common shareholders. Once you understand the concept, it will help you make decisions whether you'd like your spouse or business partner to have preferred shares, or common shares, or voting shares, or non-voting shares, etc. Another important concept to understand is the difference between authorized and issued shares. Authorized shares are the maximum number of shares that a company can issue, or is allowed to be issued in future. Issued shares are shares that have been distributed to shareholders from this pool of authorized shares. For instance, if a company has 1,000 Class A authorized shares, but has only issued 100 of them, then there are still 900 authorized shares available for future issuance. However, please note that, if only some of the authorized shares are issued, then there is a risk of dilution, which impacts your ownership in the business. Let's go over an example to understand better. Let's say, the company has 2,000 authorized shares, out of which it only issued 1,000 shares, so it has 1,000 shares as balance to be issued in future. You own 100 shares out of the 1,000 issued shares, so your ownership is 10% in the company, which is your shares of 100, divide by 1,000 issued shares. Now the company issues another 1,000 shares, so the total issued shares have increased to 2,000, but you still own 100 shares, so now your ownership drops from 10% to 5%, that is, your shares of 100, divide by 2,000 issued shares. It's important to understand this concept, as it impacts your ownership and control in the business, depending on your percentage. This is where reorganization of a business comes in place. If you want to change the way dividends are issued, or want to add in a family member, or remove a family member's rights in the business, etc., then you will need to reorganize your share structure accordingly. For single owner, it's very simple. You would set up a company and create any number of Class A shares, as you have full control and get all the profits of a business. However, if you have a family member or business partner in your company to split income with, then there needs to be tax planning of share structure in place. There has been some new rules that will trigger extra tax if the tax planning is not considered properly. For example, if you decide to include your spouse in the business and share the dividends, then it has to be reasonable. That is, the spouse needs to be active in the business or have made a significant investment to make sure tax on split income is not triggered. Tax on split income, also called TOSI, is taxed at highest rate if dividend is not split with proper tax planning. Feel free to check out my video on TOSI for more details. Hope you have a better understanding of what shares are and how the share structure works in a company. That's all for this video. If you have any questions, comments, or would like me to explain any other tax topic in detail, please feel free to drop a comment below. If you found this video helpful, please give it a like, hit that subscribe button, and share it with your friends who could really use some help. Good luck. Bye for now.